Good morning, my name is Carl Williamson. It's February 2023 and I'm speaking to you from our London offices. I'm the manager of the Nexus Global Solutions Portfolio and the Nexus Global Dynamic Portfolio. It's February and equity markets have started the year on the front foot as January saw some of the best returns we've seen in several decades. The Nexus Global Solutions Portfolio was up 3.5% while the Nexus Global Dynamic Portfolio was up 4.6%. The positive start to the year was based on an improving fundamental outlook, as we saw an end to zero COVID policy in China, falling energy prices, and an increased feeling that the central banks were reaching the end of their hiking cycles. The inflation outlook is clearly improving, with the Fed's preferred measure, PCE, falling below 5%, having fallen in the past 3 months. In Europe, a relatively mild winter has diffused the energy crisis. Gas storage in the EU stands at about 75%, having been about 35% this time last year. The average purchasing price for gas in January was some 55% lower than it was in the second half of last year. Going forward, a more balanced gas market should help mitigate some of the fiscal squeeze we've seen and the squeeze we've seen on household budgets. The abrupt end to the zero COVID policy in China has raised expectations that China can see a strong recovery in the first half of this year, benefiting it and its trading partners. In line with the previous experience of the West, we should expect to see pent-up demand and excess savings increase consumption as we move forward through the year. Falling energy prices dampened the performance of the energy sector, and more defensive areas such as healthcare and utilities lagged the broader market in January. Value stocks, which outperformed growth stocks by around 24% last year, underperformed this year by about 5%, as we saw a resurgence in many growth areas. With regard to individual stocks, those stocks exposed to China had another good month in January, with Prudential being a notable performer. As previously noted, higher growth stocks had a better period, and a number of our technology stocks performed well during the month, including TSMC, ASML and Micron. Last month we said that equity investors may be prepared to look through short-term issues with equity valuations near their long-term averages, and that proved to be the case in January. The end of the zero COVID policy in China and a more resilient European economy should continue to support corporate earnings. Clearly risks remain, including the risk that the improved growth outlook results in more stubborn inflation and tighter monetary policy. It's been my pleasure to speak to you, and I look forward to speaking to you next month.